Hey, hello everybody. My name is Bob Lang with explosiveoptions.net. I'm here with my good friend and partner, Sam DeMarco, who runs our spread trader product. And um, I've been on kind of a media blitz lately, last couple of months, and I've been going around to New York and doing some media with Schwab and with Yahoo. And more recently, I did one with CNBC, and I was on their Market Navigator segment. And as you can see here, Dom Chu and Kelly Evans were on during the afternoon. This was done on April 29th, 2025. And you can see during this segment, they had me on there, and I was actually from the New York Stock Exchange. And prior to that, they'd asked me about some strategies that I thought we could implement and share with the audience, something that I'm doing related to options. So there I am right on the screen there from New York. And my thought was an idea about a trade on Meta platforms. META is the symbol for that. And where I wanted to go with it was clearly a long trade idea, because I looked at the chart, I looked at the opportunity there, how the stock had done prior with in front at post earnings on a couple of last 3 to 5 quarters. And it's other than being a nice opportunity long. Further, the stock had fallen sharply. You can see on the chart over there, the stock had fallen sharply from the all-time highs just a couple months ago, from 735 all the way down to about 480. Huge drop, 30%. But now it's making a comeback, and it got above that downtrend line there. And I was looking for that 630 level, and you can see, you could have seen there back, that was an interim high in March. And I targeted that level when I was talking about this with Market Navigator with Dom Chu, but I also saw that on the chart, and I saw an opportunity where the stock was trading at about 548 before the day before earnings came out. So my trade idea here was, well, let's take a little bit of moderate risk here, take something out of the money. And so I went with the 560 call, talked about that one. But that was expensive. That was about 26 bucks, $28. It says $28 it'll say 28 on the screen here, 26 on the screen, but it was actually about 20, almost 28, and then it came back to about 25. So it was about $26. Still a little bit too much for me to pay. So I wanted to ease off on some of that, lay off some of that risk. Sold the 600 call. Why the 600 call? Because that was about $52 above where the current price was, and the expected move post earnings was 48. So if the stock just did a little bit less than the expected move, I could capture a lot of that premium from a call out of the money, far out of the money. $600 was about $52 out of the money. And if we could, just for 3 days, 2 days, actually, because the earnings came out Wednesday, I only needed 2 days worth of premium to worry about an expiration. And that's the end of that. So, what transpired there was looking at the 560 call against the 600 call. So I'm going to go long the 560, short the for May 16th, short the 600 call, which expired May 2nd, for a net of about $21. So I've effectively cut my risk by about 25%. What's the downside? If the stock tanks, I'm losing all that premium, but I'm only going to lose 21 versus 26 if I had just gone along with a straight call. As it turns out, this was just a phenomenal trade result, because ideally we would have wanted to see the stock finish Friday, May 2nd, right at or near 600. It finished at 597. Absolutely perfect, because the 600 call, which I sold for $5, disintegrated, went to zero. Meanwhile, I'm long the 560 call still, but that price has ballooned. Which I bought it at, say, $26. It's now worth 46, because I've got 2 weeks of time left to go on the option. Now we're from this recording, we're about a week and a half away. Still have with 2 weeks left to go. I'm deep in the money with this call option that I'm long. and I have other options that I could do. I could sell a call. I could just leave it alone. In this case, what I did is I've left it alone, and we'll see what happens in the next couple of weeks. I do have a mental stop in place that if the stock closes below 590, I'm out. It'll still be a huge winning trade. It'll be up at about 100%. Now net's about up 120%. So that was it. I exposed that for the whole entire audience of CNBC. They were very happy and proud of the trade idea that we put out there. It's an extremely attractive trade, extremely attractive stock that a lot of people follow. It's on the same line as a Tesla or an Apple or an Amazon. Everybody follows Meta platforms. They love to trade this thing. So that trade idea was out there, and for everyone to see, was done in real time. And I'm hopeful they said they're gonna bring me back on too, or hopefully that'll be soon. But that was it. So what I wanted to do is share with you my partner Sam DeMarco, who does these things on a regular basis. He trades these trades brilliantly on a regular basis, which means every single day. He runs the spread trader. He does an absolutely remarkable job running that, and I'm proud to call him my partner, my friend. And it's I honestly haven't met a smarter person in my life than Sam, because he's a brilliant math guy. But he's always working. He's always working in a way to, how can I do better? How can I make a better trade? How can I make a little bit of money, keep my risk down on a regular basis? So, Sam, what do you think?
Well, Bob, first off, you did an excellent job in that trade. I mean, the strikes, you could not have hit them better. That was excellent. So congratulations on that.
Thank you very
What I really like about that trade is that you took advantage, and this is what I do as well. We take advantage of that implied volatility, and that quote, we often refer to it as juiced up trade, where there was some exceptional premium to take, and we took it instead of paying it. And that's the smart thing with these trades is you're taking some premium in, and that is really lowering your risk significantly, and you're able to get that additional premium when you have these times. So this is an excellent trade. This is why I like to do these things. It cuts your risks, it gives you some premium, and it still allows you for that upside opportunity. So I mean, this is practically a double plus on this trade, because you're also keeping that premium as well. So
much.
this is why we do the trades in the spread trader this way. Our most successful trade last year was a running trade on a particular stock that we did, and we just kept taking in the premium week after week after week. It works really well.
So one thing we talked about before we got the session started here, Sam, we talked about theta. What was the importance of theta? Explain for people in the audience here who are watching what that theta does for you, and why it was so key on that 600 call to watch that decay.
Yeah, so what's happening with the theta is every time you buy an option, it's a decaying asset, right? It's over time it's decaying, and the shorter time you have to expiration, the faster it decays. So when you sell premium against it, you negate that decay. So you can actually have a spread that will make money simply based on time decay.
Mm.
So I always look at my screen, and it just irritates me when I see a negative number on time decay, that I'm losing money on the time decay. So I'm always looking like, what can I sell against this?
Positive. So you're looking for positive theta, right?
I'm always looking for some kind of positive theta, and a lot of times I'll sell some very short-term calls, um, just to gather a little bit of theta, so that I don't have to watch that other option lose value.
So by their very nature, options are, you say, a decaying asset,
Yeah.
and they're the implication is that um, you're destined to lose money unless you have some driver to overcome that theta. Whether it's
Hmm.
event, if it's earnings or some FDA thing or whatever. You've got to have something driving that theta. Otherwise, the person who sold you that option is just gonna crush you, right?
That's right. Yeah, I mean, we all know, 80% options expire worthless, right? That is true. So we're looking to take advantage of that fact. The other thing that the spread trader allows and the options allows is you don't have to worry about time so much when you have time to working in your favor. So for those of you that can't stare at the screen every day or minute by minute, the spread trader allows you, the ability to sit back and relax and know that, that there's less risk built into the trade automatically. So I think that's a key factor in looking at the spreads that we do.
Well, I brought up this red trader trade page on our website, Explosive Option, and really, and as we talked about earlier, this really isn't a sales pitch, but it was more of informational and educational and identifying, you know, what we do and how we do it and why we do stuff. Now, um, um, I run the swing trader service, and I'm mostly 98% of the time just straight calls, and sometimes I'll step into a vertical or a spread or something like that, out of necessity or just to try to repair a trade. Um, but you'll often you'll do the same thing, but you'll often start spreads out. And what's the importance of starting those spreads out, um, uh, right when you get in the trade, right when you open it up?
Um, so there's a couple techniques, but the when you open up the spread, the most important thing is to look at your risk and to have an assessment of where you're going to be if this trade is going to go against you, right? And I always try to keep the trades at an equal risk level in spread trader. Um, and that really allows it for a more of a steady environment and a steady growth with that. And so that's what we're looking at for the spread trader. To me, it's about risk and getting rid of time decay. The two
Right,
things.
and it's always about managing your risk, and I think that as options traders, the ones who are successful, and I measure success not necessarily in terms of dollars in the bank. I look at people who are successful who can demonstrate their ability to stick around and do this for years,
Yes.
not months, not 10 months, not 18 months, but 10 years, 15 years. If you can, and you've been doing this for, uh, well, I've known you since what, 2016?
Yeah, so I've been doing this for over 15 years.
Right. Yeah. So, you demonstrate the fact that you can, markets are tough. I mean, it's not just now. It wasn't 5 years. It was tough in 2020. It was tough in 2008 and 2009. The markets are always tough. You're always, so it's like a surfer who's out in the middle of the ocean,
Mhm.
waiting for the perfect wave. You could wait for hours and hours and hours before that wave comes in before you're riding in, or it may not even come. Um, but your ability to wait and to be patient and to let the markets, let the statistics work in your favor. And as you said, 80% of all options expire worthless. So Sam, going back to the meta trade for a minute.
Yeah.
I talk about in our trading room a lot, about how you don't. It's not just one trade that can work. I always like to say
Mhm.
there are a lot of right answers. Some are better than others. Some are more risky, some are less risky. Um, so although this trade was a nice winning trade, and it worked out really was it's still working really nicely over here.
Mhm.
Uh, there are other trades you could have done as well too, right?
Yeah, actually, I think just a straight vertical trade on this, straight call trade, was a good winner. I mean, do something where you're paying $2.50 for a $5 spread. You don't do anything extravagant. Maybe put 2 contracts on, risk $500.
So is that
Um,
what it tell everybody what you did?
yeah,
Yeah.
so I saw you put that trade on CNBC, and I said, okay, let me see what I can do here. I really didn't want to go for the whole, you know, still the $2,000 for just 1 contract. So I said, I'm just going to throw a call spread on. And so I think I threw a 560, 565 call spread for 250. And I put just 1 or 2 contracts and I sprinkled them into my account. So if I lost $250, I wasn't going to be upset about it. And of course,
So you
Meta.
end up doubling on. You got to double on those, right?
Yeah, so I got a double on all those. And actually I just let them expire and let the the investment house take care of that money. I didn't
Yeah.
even close those out.
No.
So
So even though you had a much narrower spread than I did, it it still turned into a fantastic winner, and you've defined your risk. You've only had it sounds like it was a risk one to make one.
yeah, it was a risk one to make one, and I put 2 contracts on, so therefore it was a $500 risk if I lost it. Um, and it wouldn't have hurt.
Yeah, but then yeah, so and that's the thing is that you manage the risk as opposed to just buying a 560 call straight would have been like again $2,600 versus
Correct.
what you paid, and that 560 trade worked out really well. I mean that was a little bit more than a double, but interestingly enough, your trade paid 100%. That trade is up 100 and 10%. Um, but what's interesting is that you're um, you had almost a similar return,
Yeah.
far less risk. That we call that a far less less beta than you had on the just a straight call. So
Yeah,
far
and
less,
if I had put on 10 contracts, I would have had a double. So
right.
it,
That's right. Either way, you would have had a double, right? If you put in 10
correct.
contracts, 100 contracts, or 5 contracts, or 1 contract, it doesn't matter. You would still have only had a double, but you would have increased your risk exposure by putting more money up front. And if it didn't work out, right? I think the key here, Sam, is to understand that people need to understand that you know what we're not Nostradamus here, all right?
No.
We can't see the future and say we know what's going to happen. But what we try to do, you and I, is well, let's try and put some odds in our favor, right? And if we're willing to take risk, and I always like to say, you got to take risk in this game. You can't steal second base with your foot on first in
Hmm.
baseball parlance. I like to always say that if we're willing to take a little bit of risk, and we understand that we can get paid well for that risk, then my answer is why not?
Yeah,
So,
exactly.
um, all right. Well, anything else you want to add there at all?
No, I think spreads are, I guess the biggest thing with spreads is lowering the risk. I can't emphasize the lowering the risk and the theta there. Um, Especially with around earnings trades. They're a great way to bypass the high volatility,
Yeah.
or a great way to take advantage of the volatility. So, and there
So,
are many strikes and trades that could have worked with Meta.
that's right. That's the important point.
Yeah.
Is not just one particular set of trades that could work a vertical, a diagonal, a straight call. You could have sold puts. You could have sold naked puts if you wanted to.
Yeah.
You probably sold the 580 puts. That's quite a bit riskier because certainly if the stock tanks hard, you're going to put the stock at a much higher price. There's some risk there. But if you're willing to take the stock in at a lower price, then that's great. Um,
Yeah.
but I think that point about several different winners should not go unheard right now, and I think people really need to understand. And then so Sam Sam runs the Spread Trader, and he's been doing this for a few years now, but he's been trading spreads for many, many years. And I think this is a great opportunity for anybody who's watching this to jump in, sample it with Sam, take a look at what we're doing, and we'll give you an opportunity to get in. So shoot us an email. Shoot Sam an email. His email is sam@explosiveoptions.net, or me, bob@explosiveoptions.net, and we'll get you going in the Spread Trader. Thanks very much, Sam.
Absolutely. You're welcome, Bob. Have a great evening.
Thanks, everyone. Take care.
All right. Take care.